Anybody else feel like your gas bill is looking like your grocery bill, and your grocery bill is looking like your Costco bill, and your Costco bill feels like what you pay in rent every month? Yeah, inflation has been crazy. And I don't know if it's going to get any better anytime soon. I think the Fed is increasing rates like crazy. Obviously, they are, but it doesn't seem to be having as immediate of an impact as they had hoped, and which is why they keep increasing the rates even more. They went from a half point increase to a 3/4 point increase, and inflation still is going up and to the right. So we'll see. But here's the question that I've been getting asked by a bunch of my students and friends, and that is, how is inflation impacting venture capital? Well, there are a bunch of different things. So first of all, we need to back up a little bit. How did we get to this situation, right? Well, first, we need to understand what is inflation. Now, obviously, inflation is rising prices, but why do prices rise? Prices rise fundamentally based on this general equation, which is the velocity of money times the amount of money in the supply. So that the money supply part's really easy, right? More money into the system, right, increases the money supply and generally should increase inflation. But the other part of it that is a little less obvious is the velocity of money. And the velocity of money is how often the money actually gets used. So if tons of money is being pumped into the system, but everyone's sitting at home and shoving the money under their mattress and not really doing much with it because they're stuck at home because of COVID and they can't leave, and they're just saving the money essentially, you're not going to see a huge increase in inflation, which is why during COVID, even though we were printing tons of money and sending out tons of stimulus checks and the money supply was going way up, you didn't see that big of an increase in inflation because people just weren't spending it. Fast forward to 2021, markets start to reopen, communities start to reopen, people start to go do stuff, they go travel, they start buying things, right? And they have all this pent up demand because one, they've socked away a ton of money under their mattress, and two, they're just excited to get out and do stuff, right? You then see the velocity of money spike, right? And that, coupled with a money supply, creates massive inflation, right? And how does the Fed going to fight inflation? And what does that mean? Well, that means that, the gas prices are going to go up. It means that your food prices are going to go up. Everything's going to go up. And in many cases, it will go up by more than your increases in income. And so on a real basis, people are actually losing money. So let's talk about how all of this impacts venture capital. Well, there are two big ways that it impacts venture capital. The first one is when all of this money was flowing into the system, venture capitalists didn't sit on their hands and just wait and see what would happen. Right when the pandemic hit, there was a bit of a lull in venture activity because everybody was uncertain of what was going to happen and they wanted to reserve cash in case things got bad. But fortunately, things recovered, broadly speaking, outside of a few core sectors relatively quickly. In fact, if anything, venture capitalists did incredibly well because there was a shift to more digital technologies and solutions faster, right? Google was saying that they were seeing 2 to 3 years of adoption in a matter of months of technology services. And so what that meant was VCs were spending a lot of money. And because a lot of money was being printed and put into the system, they were able to raise a lot of money from investors. And so you had these gigantic funds getting raised. Like every month, it seemed like somebody else was raising another multi-billion-dollar venture fund. And this money had to go somewhere. And the other thing was that these technology companies were doing really well. And so everybody looked like an absolute genius because they had backed these technology companies. Those technology companies were performing really, really well. And they were going public, they were getting acquired, they were generating great returns. And then those VCs were going back to investors and saying, hey, look, we're geniuses. You should give us more money so we can invest. And so you had all this money flowing into the sector. And then that money has to go somewhere, right? VCs need to deploy the money. That then pushed up the prices of companies, right? It's very similar to the inflation equation that we just talked about, right? Lots of money flowing in, that's your money supply, and then lots of VCs feeling the urgency to deploy that capital, right? That's your velocity of money, and seeing really good returns, right? Like I put money in one day and then the next day it's almost doubled, right? So there was a lot of pressure and incentive to do so. So velocity of money goes up and that then rises valuations. Then what happened? Well, everybody started to see inflation start to creep. And when inflation starts to creep up, investors start to get skittish, right? Because they know that the Fed is going to start increasing rates. Inflation has all kinds of problems that it puts on society, right? It makes it harder and harder for people to afford their groceries and gas and so on and so forth. And so they know that all of a sudden, once inflation starts to rise, the cost of capital is going to go up. The cost of capital is simply what you have to pay in order to get access to money, right? If you're going to borrow money, that would be the interest rate. If you're going to take money on and sell equity in your company, then it's the implied rate of return that investors demand in order to be willing to buy your equity, right? And so basically, as the cost of debt goes up, as the Fed is raising rates, what that means is that generally speaking, the overall cost of all capital, of all money, is going to go up as well. And as the cost of capital goes up, it becomes harder for companies that are reliant on cheap capital to grow quickly to get access to that capital. In fact, there are a lot of technology companies that are really supported by low cost of capital, right? It's like, hey, I can basically get capital for 2% interest, right? I can put that into my business and I can grow my business by 10, 30, 40, 50, 100%, 100% year over year, right? The delta between those two, I'm paying 2%, but I'm growing 100% is massive, right? And so companies are highly incentivized to do that. But what that causes is them to be super reliant on cheap capital. What happens when that cost of capital goes from 2% to 10%? You still have a healthy margin there to grow, but what happens if there are just fewer capital providers and they take longer to fund your business, right? And you need the money today, right? All of those things can start to impact your ability to raise capital and to grow, and then that slows your growth. And then because you're growing slower, now it's not as an exciting story for investors to invest, and you enter into this vicious cycle where growth starts to slow, then it becomes harder to raise more capital, and because it's harder to raise more capital and capital becomes more expensive, right? Then it becomes harder to raise more, and you just continue to almost nosedive, right? Okay, so what this did, coming back to venture capital, is public market investors looked at all these technology companies that were burning a lot of cash, and they basically said, these companies are not going to survive, or they're not going to be as valuable as they used to be because their cost of capital is going up, which means that they're not going to be able to grow as quickly as they have been in the past, which means they're not going to be able to generate quite as much profits in the future as we thought, right? Both because they won't be able to grow as fast and because they're going to be spending more money on growth. That then resulted in the collapse of tons of valuations of great technology companies. If you look at the NASDAQ, if you look at some of these top tech companies, they are down 70 to 80% because of that. Now, part of that is because there's a flight to safety, because there's a lot of uncertainty going on in the market and people don't know where things are going to pan out, if we're going to have a recession, when it's going to happen, what that's going to look like. And so they're funneling money away from high risk, high growth over to more stable, cash flowing businesses. So you're getting a double whammy. One, investors are saying, hey, I want to put my money into something safer. And two, I don't think that these things are going to be worth as much in the future because they're not going to be able to generate as much profits. And so these stocks are taking a huge hit. Let's pull that back to VCs, because VCs don't invest in public markets, but we do care a lot about what's happening in public markets because public markets are where we oftentimes are able to get liquidity on our investments. That's where we sell and generate a return on our investments. And so if we watch an amazing technology company drop by 80%, that's going to affect how we think about investments and valuations on the private side, right? If at a bare minimum, we're going to look at it and be like, hey, I don't know what's going on here in the public markets in terms of where things are ultimately going to stabilize. And so I'm just going to take a hands-off approach from investing, and I'm going to wait until public markets stabilize and I have a better understanding of where valuations will be before I invest. Well, if you're a company and you hear that, that's a really tough message to hear because you may need the money today, right? And if you're in a desperate situation, you're going to have to give up on valuation, on terms, structure, a lot of those things, which is ultimately going to help drive down valuation and shift the power from entrepreneurs back over to investors and VCs. Here's the one last thing I want to talk about that's a little bit unique to venture capitalists and that is a little bit of an inside track. The way that venture capital funds work is they go out to investors and they say, hey, investors, commit a bunch of capital to me, right? So maybe it's commit 100 million to my fund. Venture capitalists then get paid based on two things. They get paid management fee and they get paid carry. The management fee is a percentage of the total assets that they raise. So typical is 2 and 20. So 2% of what they've raised is paid out every year as management fee. And then 20% of the profits is paid out as carry. So if I take my $100 million fund and I turn it into a $300 million fund, I generated $200 million of profit. I'm going to capture 20% of that $200 million or $40 million as profit. And payment as carry to the venture capitalist. That part's okay because inflation will, kind of do its thing. Rising prices and exit values and all of that. Carry kind of takes care of itself because it's a percentage basis. But the management fee, on the other hand, is tied to the assets raised. So if I've raised $100 million and I'm pulling down 2% to cover my operational expenses every year, that's 2%. And that's fixed over the next 5 to 10 years. If inflation is rising, then the purchasing power that I'm pulling off of my management fees is declining. And the faster the inflation goes up, the faster that the purchasing power of my management fees declines, right? Which means that as a VC, you're incentivized now to deploy the capital as fast as you can so you can go raise a new fund, hopefully a larger fund, that can generate fees that offset how much you're losing on real terms. The flip side, though, that makes that challenging is all of these VCs are watching their portfolio companies take hits on valuation, and the cost of capital is going up. So the ability to raise a new fund is getting exponentially harder, especially in this current environment. So it's a fascinating, interesting space and what's going on and how inflation is really impacting things. This has never really happened before because the venture capital industry didn't really exist last time we had very high inflation. And so a lot of people are trying to figure out what's going to happen. How do they position their fund? Do they wait? Do they deploy as much capital as they can? Do they take advantage of low valuations? Or do they avoid low valuations and rather invest at higher valuations later with more certainty? And every firm kind of has its own strategy and thinking around this. From my perspective, I think in some cases now is a great time to be a buyer of technology because I think as there's a flight to safety, there is some artificial downward pressure on some of these tech stocks. But I don't know, right? We could still go down quite a bit more in the public markets. And so this is not investment advice, but hopefully this is a good framework in terms of how to think about markets and inflation and the impact that they can have on your investments, both in the public markets as well as a venture capitalist in the private markets. If you liked this video, check out my next one where I react to a Shark Tank pitch from the company Signal Vault. Thanks.